Hello everyone, this is module 6 of financial analysis for decision making. In this module, we are covering value measurement via discounted cash flow, and this is the introduction of this module. In this lecture, we'll cover value measurement using discounted cash flow analysis. Let's look at the agenda of this module first. First of all, we'll cover value measurement using discounted cash flow analysis, then discounting cash flows, forecasting cash flows, fair value using net present value, and finally we'll look at what are the limitations when you use discounted cash flow analysis. We know that accounting has got some sort of barriers, and accounting information has its limit for corporate financial analysis. For example, in our previous lecture, we have seen that there is a difference between market value of equity and book value of equity. Many items in balance sheet also differ from their market value, so these limitations often make it difficult for financial analysis to do financial analysis properly. Let's take an example. Suppose Apex is planning to take over Bata. In this case, Apex has to buy all the shares of Bata. That will be the market value of all the shares of Bata. So Apex has to pay the market value of Bata's equity. But this is not everything. Apex has to take over all the debt of Bata as well. However, Apex will also get the cash position of the Bata. So in this case, the enterprise value of the Bata for Apex will be market value of equity plus all the debt minus cash. So to maximize shareholders' wealth, we need to look forward, and our forward looking information will help to take present investment decision, and for this we need to use some tools to bring the forward looking information back to the present decision point. So buying a share in Bata today entitles the investors to Bata's future cash flows. For example, if you buy a share of Bata, you might receive dividend. There might be also a capital gain. So these will be your future cash flows. To help an investor to decide whether to buy Bata's share today, you need to answer several questions. For example, what are the expectations of future cash flows? So what could be the Bata future dividend payments, or how much the investors might receive as a dividend? So these will be Bata's future cash flows. Now the next question is, are these cash flows guaranteed or risky? We know that equity investment is never ever guaranteed. There is no guaranteed dividend payment in the equity investment, and there is also risks, like if you buy a share of Bata, your share price of the Bata might decrease in future. So in case of equity investment, cash which will be generated by your investment is not guaranteed. In the meantime, there is also risks involved in the investment. Then you also need to analyze whether your money is going to lose value over time. So we know that inflation usually decreases the value of money. So when you invest somewhere, your investment value might decrease as a result of inflation. You might also analyze alternative investments. So instead of buying a stock in Bata, you might also think of investing your money in Apex as well. So all these questions are needed to be answered when you decide to buy the share of the company. So all these questions are forward looking. Let's look at the graph which shows the price and dividend information of Kellogg's. So if we look at the dividend trend of Kellogg's, you can see that there is an upward trend of dividend of Kellogg's. In the meantime, if we look at the price per share of Kellogg's, it also shows there is an upward trend of share price of Kellogg's. So overall, from this trend, we can predict the future dividend payments or the future price of the share of Kellogg's because it's a long-term trend. So some cash flows are predictable, like Kellogg's is a renowned company, is an established company. For these companies, we can predict their cash flows to some extent. But this is not always easy for other companies. For example, if you want to predict future sales and expenses, it is often very difficult to predict future sales and expenses because you have to consider the competition in the market. Competition might increase in future. For example, once upon a time, Bata had the largest market share in Bangladesh. Now there are many shoe companies which are operating in Bangladesh like Apex, and there are other companies as well. So competition in shoe industry or in leather industry is really high. As a result, Bata has also lost its market share and sales due to the competition. So it is never ever easy to forecast the sales and expenses due to competition. In the meantime, the labor cost cannot be predicted, and Bata also does not know what will be their raw material price in upcoming years because their raw material is leather. Leather price fluctuates. There are also external factors like economic factors or other factors which we need to consider. There are also other risks which are completely uncontrollable, like inflation. Not a single company can control the inflation, and there is also an opportunity cost. So all over, these things are not so easy to predict. Therefore, to incorporate all these factors, we or financial analysts use discounted cash flow, which is often treated as gold standard in finance. This discounted cash flow methodology is the standard forward-looking valuation technique in finance, and it provides absolute valuation of investment opportunity. However, financial analysts often use other valuation techniques or other techniques when they evaluate an investment, like ratio. So this is not discounted cash flow is not the only methodology that financial analysts use. Financial analysts also use other techniques by the side of discounted cash flow.